Good morning and welcome to the Asian Impact webinar. I'm Alexander Rabe. I'm an economist in ADB's Department for Economic Research and Development Impact, and I'm delighted to moderate today's webinar on how to mobilize private climate finance for sustainable development. Now, why is this important? Well, we are living in times of ever more frequent and severe storms, heat waves, and floods. And the devastations these events cause have been supercharged by climate change, which in turn undermines our collective efforts to foster resilient and sustainable development. But reducing emissions and adapting to climate change requires trillions of dollars. And so the question is, who can pay for this? Now, clearly, the fiscal headroom is limited for the public sector to go it alone. Thus, the private sector is called upon to provide financing. And in this webinar, we want to answer in particular three questions. A, what is it that attracts the private investors into climate finance? B, what is it that still holds them back? And C, what is it that we can do about it in terms of the policy solutions? Now, the insights we discussed today are informed by the first edition of the Asia-Pacific Climate Report that we launched in October of last year. And I invite you to review Chapter 4 on how to scale up private climate finance. That chapter, along with the report and a host of background papers, is available online. And in fact, we have already posted the link here in the chat. Now, to discuss these matters, I'm very delighted to be joined by distinguished experts. First, there will be my colleague Shu Tian, who's better known as Grace, and she will set the scene with a presentation based on the report chapter. We will then turn over to our panelists, and please join me in welcoming, first of all, Scott Roberts. He's the head of the Green Finance Hub in ADB's Regional Department for Southeast Asia. Further, we have on the panel Esmyra Javier. She's the Senior Climate Change Specialist. And last but not least, Jason Mortimer, who's joining us from Nomura Asset Management. He is the head of Sustainable Development and Fixed Income and also serves as a Senior Portfolio Manager. Please give them a warm welcome. Now, importantly, I invite all of you online to post your questions in the chat. And if you do feel that somebody has already put in your question, then please give it a thumbs up, because that will rank the question higher on my watch and get it more likely to be answered. Of course, feel free to indicate whom you'd like to address your question. Otherwise, I will exercise my best judgment here. Now, without further ado, let's kick it off then with your presentation, Grace. The floor is yours. Thank you.
Thanks, Alexander. Let me share my screen. Okay, thanks, Alexander. As Alexander just mentioned, this presentation is about scaling up a private climate capital for resilient and sustainable development. This presentation is based on the chapter in ADB's flagship report, Asian Pacific Climate Report last year. This chapter was motivated by the fact that climate finance needs are huge in Asian Pacific and remain largely unmet. According to the IMF estimates, if you see in this chart, Asian Pacific requires around $1.1 trillion a year to cover mitigation and adaptation needs. How much do we have now? Our current annual climate finance supply is around $300 billion in 2023. So we are still around $800 billion short. Then the natural question is, how can we close this gap? Given limited public resources and rising debt levels during the pandemic, mobilizing private capital is becoming a critical issue to close this large climate finance funding gap. However, much progress is still needed. As you can see in the left-hand side, the private sector capital contributed around 1/3 of the total climate finance in our region during 2018 and 2019. This 1/3 of shares is much lower in the global level, which is around half. If you see the left bar in the left-hand side in the chart, so we are below the global average on this part. And then this level, either 1/3 or half for now, both are much lower than IMF's estimate. If you see the right-hand side charts, that private capital should contribute to around 90% of the climate finance needs by 2030 due to the rising climate finance needs and the limited public resources. So you see, we still face a large gap to be mobilized from the private sector. In this research, we aim to understand what factors drive private climate capital, discuss challenges that prevent private sector to conduct climate investments, and then we outline possible policy options to address these challenges. This table actually summarizes factors that affect private climate capital based on the literature. We try to help us to understand this context. We group them into 4 categories. First, based on whether they are direct financial motivations, these factors are grouped into direct and non-direct financial drivers, as you can see in the left-hand side of the chart. For example, policy incentives, concerns of damages from physical risks associated with extreme weather events. These which will affect cash flows of the investments, so they can be formed as direct financial drivers, as you can see in the tops of these charts. While some other factors like a changing in stakeholders' preference or social norms, or a company's climate commitment, which is outlined in the bottom part of this box, do not definitely have a direct financial implications, although these non-financial drivers could gradually evolve into financial drivers. And then on the other side, these drivers can also be grouped into push and pull factors. Push factors are those who are considered out of risk management and mandate considerations. You can see in the top left orange box. For example, investors make climate investments to manage climate-related physical and transition risks. Well, this you need to do this out of risk management consideration, or to ensure compliance with changes in policies and regulations, meet mandates from your clients. Such changes actually are all from a mandate or requirement or downside risk considerations. So we group them as pull factor. On the other side, there are some factors which we call pull factors. If you see the right side top orange box, they form some incentives of private climate finance to leverage new business opportunities. For example, investors might want to invest in new climate-related business models, have new opportunities in sustainable finance markets, and also avail various incentives from the public policies. So some investors might also have considerations like reputations and branding considerations. They all forms as incentives to tap new opportunities. So that's why we group them as a push factors. And then push factors sometimes can evolve into pull factors too. In the following slides, actually, I will discuss some challenges that prevent mobilizing private climate capital from 3 large areas, being climate policy, financial market development, and market responses, which are driver these changes in all these factors that we summarized in this table. This slide actually summarizes some new evidence we found in the paper. If we trying to tap a message, it is about certainty and alignment in the climate policies are very important to attract private climate capital. Climate policy uncertainty heightens risk perceptions of investors, and then will delay decisions to make climate investments. If you see the right-hand side chart, it is based on a research paper that our team conducted. It shows that greater climate policy certainty, which is proxied by the adoption of climate laws, especially those climate laws with quantitative climate targets or net zero goals, so which are more clear climate laws to reduce the policy uncertainty. And then after adoption of such climate laws, the investment in ESG assets rise significantly in the long run. So if you really see the blue lines on the right-hand side, actually the ESG asset holding increased by around 2 percentage points after 12 quarters of the adoption of these quantitative and net zero climate laws. Besides uncertainty, misalignment among existing climate policies could also weaken related incentives of these to these private investors. One typical example is really, for example, when government is implementing clean energy subsidies and carbon pricing, and then which forms a positive carbon prices. And then at the same time, there is fossil fuel subsidies, which forms negative carbon prices. So you will hear more actually from the next AIW, which another when the carbon pricing chapter will be presented at the next event. And then on top of policy alignment and policy certainty, we also show that effective policies, climate policies, will attract private climate capital even from abroad. Actually, this study is conducted by Alexander. Not only carbon pricing and then other subsidies, those kind of domestic climate policy works. In this research, actually, if you see the right-hand side, the Global Investment Fund can provide more capital to Asian economies upon the announcement of U.S. Inflation Reduction Act, or IRA, if you see here in this chart. So the median economy in Asia, in our region, received additional inflow of around 4% of the GDP in the 3 months after the IRA was announced. So this means that actually effective climate policies can also interplay with domestic policies to incentive private capital worldwide. And then more importantly, such impact is more pronounced in countries where climate policy scores is higher. So that actually shows investors allocate more money into sustainable assets after the IRA was announced, which is a US climate policy. And this kind of reaction is jointly determined not only by the IRA, which is a foreign climate policy, but also the quality of their domestic climate policy qualities. Now let's turn to the second large area, which is the financial markets. Although we already observed the rapid development in the sustainable finance market, which is supposed to partly funding the climate finance. Still, there is lacks a climate enabling financial markets. Just last month, UNEP launched a report on climate related risks in financial regulations and supervisions in Asia Pacific. And then it outlines 3 key aspects for enabling policy environment, including the corporate disclosure, taxonomy, and then also due diligence. So let's see how we perform. The left-hand side chart is actually corporate disclosure. We see that during the past several years, climate disclosure has been on the rise among the public listed companies. However, actually, these are mostly large companies that is publicly traded in the stock markets. There are more non-public listed companies, especially small companies, not even mentioned SMEs. They don't have the resources and capacity to conduct this climate-related disclosure. So this poses a huge challenge in the supply chain to mobilize private climate finance. On the right-hand side, actually, it shows that Asia actually sees a rapid development in sustainable bonds. Actually, from 2021 to 2025, the size of sustainable bonds outstanding nearly tripled, slightly less than 3 times, but nearly tripled. Still, sustainable bond market in our region, although we are the second largest regional sustainable bond in the world, is much smaller compared to Europe in terms of the relative size. So in our region, sustainable bond market account only for around 3% of the general bond market. But this share is around 8% in Europe. So we are still facing a relatively small sustainable bond market, although we are only second to Europe in terms of absolute size. And among this sustainable bond market, only around 6% is allocated to fossil fuels and hard to abate sectors. So still more efforts is needed to attract investment to support the transition. And then having a clear and widely acknowledged taxonomy will help to mobilize related investments to these transition-related investments. And then now we turn to the last area, which is the market responses. So various market barriers also hinder private climate capital. Actually, this part is mostly widely documented in the operations. For example, some climate projects face sector-specific challenges. For example, some sectors like renewable and EV, they rely on a few critical minerals like copper, rare earths, and then they face supply side constraints due to the mining capacity limits and also the supply concentrations. If you see the left-hand side chart, this is widely known. And then this is just an example of some sector-specific challenges that needs to be considered separately. And then there is also a general market features that affects climate finance. For example, commercial viability of climate projects is challenged by lack of insurance, high upfront costs, relevant long payback horizons, high preparation costs, and related social environmental risks. And then all this affects the risk return profile of climate investments. And then especially for those in emerging markets, some macro level risks also play a role, like a political risk, currency risk, and also transfer risk, sending money back. For example, in the right-hand side, actually, it shows the cost of capital of renewables in selected emerging markets. But if you see the dotted lines, they are the range of the cost of capital in advanced economies. So you see how much more emerging market is paying for this due to these macro factors. So all these kind of issues needs to be addressed to leverage more private capital and private climate investments to close the funding gap. So in the last slide, I would like to outline quickly some suggestions that the report comes up. First, this slide is developed by Jason. So what we can tell from this slide is aligned and a holistic climate policy package will help to drive private climate capital. If you really see each column of this table actually show a different type of climate policy tools. So of course, the darker green means they are implementing at a more satisfactory or good level. And then yellow or lighter green means it is still in a relatively underdeveloped or developing stage in implementing such policy tools. So if you see the purple circle I put there, advanced economies tends to have a more comprehensive policy package, which actually serves as a clear policy signal, which also reduces policy uncertainty that with such a comprehensive policy package, which is also a good mix of price and non-price measures, private sector has more confidence to make private climate investments. And then if you really compare to the developing Asia bottom panel, we see less comprehensive policy package there. So basically, we suggest that more aligned and more comprehensive policy might work. And then on top of that, a holistic policy package will also serve. So for example, just a short example, for example, transportation sector. If you already introduce some transportation emission efficiency standards, and then to help people to meet such a standard, actually, it's better the policy is also there to support EV charging infrastructure and driving incentives, like easier to get a plate or something like that. So such a policy can work together to form synergies. That's what we mean aligned and a holistic policy package. And then on top of that, from the financial market part, what we see based on the previous evidence is really we need to grain the financial system to mainstream the pricing of climate risks. This forms the incentives to shift more capital to climate-related investments. And then on top of that, we need to encourage more comprehensive and faster adoption of climate disclosure. And then also we need to equip the investment to transition projects with more credible transition taxonomies to foster the transition planning and investments of investors. And then lastly, it is useful that a government to adopt innovative de-risking instruments to attract private investors with different risk return preferences and mandates. And then also public sector can definitely play a role to correct market failures by structural changes in the market. For example, addressing the entry barriers and also early stage challenges of climate projects, and then also overcome market rigidities such as long-term locked-in purchase agreements, which is important in transition finance. So that is largely the key messages that we have in this report. Thank you for listening. Over to you, Alexander.
Thank you so much, Grace, for this very comprehensive presentation. Very insightful. So with that, I'd like to turn it over to the panelists. But well, actually, before we go there, Grace, there's one clarification being asked by Ashim in the chat, in the Q&A box, and he's wondering, in our matrix of the push and pull factors, where would you see mandated lending to climate and also the disclosure guidelines? He's wondering whether that could count as an indirect push factor. Could you comment on that?
Yes, it could be a push factor, especially if such a disclosure becomes mandated. And then we do see evidence that after the mandate of climate disclosure, actually companies have they have the pressure to adjust their investment and portfolios and develop related strategies. And then, of course, sometimes I think some government they start with voluntary adoption, and then some guidelines. So if it is on a voluntary basis, I think sometimes it could be a pull factor too, because there is also evidence to see those companies that voluntarily adopt climate disclosure is actually more valued by the stakeholders, I mean, including clients and governments and regulators, because that means they are ready to conduct this climate-related disclosure, and then their operations is more aligned with related requirements. So that is what we observe in the literature. Thanks.
Perfect. Thank you for this clarification. Well, with that, let me open then the discussion to the panelists. We have already a host of questions here lined up in the Q&A. Maybe a nice way to recap some of the important points also from the presentation, I'd like to turn to my colleague, Esmyra. Esmyra, you're very much involved in the broader level discussions or the global climate negotiations. If you could summarize your takeaways in the sense of what are usually the barriers perceived for bringing in private investors into climate finance?
Thanks, Alexander, and I hope you can hear me okay. Yeah.
Yes.
Oh, well, okay. Thanks. So I think good morning, everyone, and I think Grace did quite a good job in actually delivering a lot of content in 15 minutes, from the urgency of private climate finance, the drivers, and there's a number of questions here, a bit on the barriers, but as well as of some of the solutions and enablers. Now, before I respond to your question, Alexander, I just wanted to highlight that a month ago, the Climate Policy Initiative has released an update of their global climate finance landscape. And in fact, it is for the first time that the private sector contribution has crossed 1 trillion. At the same time, more than 50% of the total climate finance flowing globally. So 2023 climate finance reached around 1.9 trillion, and over 1 trillion is actually from private contributors. You could imagine that most of that finance actually goes to the mitigation side of it. In fact, 1.8 trillion. So the leftover, you can imagine, went to adaptation or building resilience in the world in terms of measures. Now, to answer, some of the key barriers, and I think Grace have actually touched on this, and it's the same in the global finance architecture that they've identified these kinds of barriers. One, of course, is the policy uncertainty and misalignment. Climate change is a multi-sectoral it affects multi-sectors. Does it means that multi-sectors actually have to also address the impacts of climate change? So you can't have a carbon tax, but then at the same time subsidizing fossil fuel imports. So there's quite some misalignment still happening, especially in emerging economies as well as the smaller countries. There is, of course, also weak climate related information available. So, of course, lack of reliable data and disclosure increases the transaction costs and, of course, reputational risk. In fact, tracking climate finance, I think, in terms of methodology and data availability, has only improved in the last 3 or 4 years. So, what we're seeing right now is more and more reliable data, which helps much of the reporting, but we also hope helps the private sector to use those kinds of information. And there's, of course, underdeveloped financial markets. And Grace has touched upon this quite a bit. Many economies still lack deep liquid markets, limiting access to long-term financing. And I think that's why it's critical that ADB and other international financing institutions work closely with ministries of finance to enable them to provide that physical or develop physical space to actually access climate finance or financing for resilience and sustainable development as well. Of course, there is limited bankable projects, especially in adaptation, and we can touch on this even more if we have time later on. So some projects lack scalable business models or revenue streams, and I think that's one of the barriers that deters investment in this space. And maybe just one more, I think regulatory and market rigidities. And again, Grace has touched on this a bit as well. Long-term power purchase agreements and lack of enabling infrastructure hinders investment. So this, and I think partly as well as the lack of enabling policies, and this is one of the discussions in the global architecture, lack of enabling policies to actually incentivize private sector to invest more in this space. So I'll stop there, and I'm happy to answer more questions later. Thanks, Alexander.
Thank you, Esmyra. This, I think, perfectly also answers Bianca's question, which I now see in the chat. If I can stay with you for a moment, Esmyra, because I see there is Aime's question, Asita's question strikes a chord here, particular on the point of the data, which you have highlighted as one of the barriers. When it comes to the policy implementation, very important is, of course, also to match the words with the impact measurement. Could you comment on where do we stand in terms of measuring maybe also the impacts of the policy interventions?
Okay, thanks. That's for me, right? Okay.
If possible, yeah.
Yes, no. There has been an evolution of how we look at indicators and how we measure impacts, right? Normally, a decade ago, we would measure impacts, quote unquote, in terms of inputs, in terms of financing. But I think there has been an evolution in terms of the development of the approach and the kind of indicators that we want. In fact, we are focusing, especially on the ADB Climate Change Action Plan, focusing more on the outcome and output of a project, because we think that if we design our projects to address the impacts of climate change, as well as build resilience, um, as well as address, the impacts of extreme weather events, increasing tropical cyclones, and what we're happening right now in Manila. If you're in Manila, it's been raining for the past 5 days, nonstop. We design our projects better and addresses that issue. And of course, finance comes in at the second point. And I think this is also a global theme that is happening around the globe, and how we're shifting our focus to impacts, including joint multilateral development banks work, um, shifting inputs, shifting focus from inputs to impacts. And I think that's one of the key ways of looking at how we can incentivize private sector as well. But yeah, thanks.
Great. Thank you. Now we have already touched on implementing these policies. So maybe, and you have mentioned the keyword projects here. So maybe it's time to turn over to Scott and shed a bit more light on how we, in particular as ADB, can help operationalize this. I'm referring here also in particular to questions in the chat by Russ Lowe, who's wondering how ADB is supporting climate capital mobilization, and there was a follow-up also by Leonel de Leon, I believe, who is mentioning that there's already a green bond project, a pilot project in the ASEAN green bond taxonomy, and how that strikes with our activities. Scott, over to you.
Well, thank you, Alexander. So I just want to commend the previous two speakers on setting the landscape. The way that ADB views private capital mobilization for climate, I think, is to recognize it is really one of the defining challenges of our time, and therefore of our mission. And responding to that, we have built into our operational targets stretch goals for what we can do on climate generally in the bank, but especially around private sector. And here, I think I would clarify the question to say, the way that ADB thinks about engaging private sector capital into projects is really to address at several levels the challenge. One is to do it directly. And already you would see in our assistance to the private sector, we work with investors who are developing projects, as well as financial intermediaries that can themselves channel funds to projects that have climate benefits. If you look at the overall ambition for ADB for its own climate finance, by 2030, we aim to have a cumulative climate finance operations of 100 billion. And within that, the direct climate finance to the private sector is 12 billion, with additional mobilization or co-financing additional 18 to 30 billion on top of that. So really, you can see that the point with this direct interventions is to mobilize others alongside us. And there's a couple of ways in which we do that. One is to make sure that where possible, we bring in other lenders when ADB is providing a loan. And that can be either a structure that we help or originate, or in some cases, we're working with other lenders as we go along, or even with pension funds and insurance companies to syndicate a part of our risk exposure after the deal is done. So this sort of work, I think, is been kind of bread and butter for MDBs, and for ADB, I think it's core to how we operate. But what I wanted to highlight is the two other levels where I think the impact can be even more magnified. And here I would maybe not use the word mobilization, because public finance institutions like ADB tried to be very specific about what that means, but really to catalyze and indirectly encourage private sector to support these climate projects. One way that we do that is through the work that we do with the public sector. So we may have a public sector loan to a government entity, but really making sure that that loan is designed so that on the back end, there's a fair amount of private sector activity which is encouraged. And this is really, I think, now core to our strategy in all of our regions. In Southeast Asia, where I work, it is now a main focus that every single infrastructure investment that we do, every single FI loan that we do, every single policy loan that we do, will have core to it aspects of design that would encourage either better standards, Could be disclosure requirements, incentives, or in some cases, outright contracting opportunities for private sector sponsors, private sector lenders to be attached to that economic activity that we're financing. So this is more indirect support. And then lastly, advisory. So we work with government agencies that may be doing a PPP transaction to structure that so it's a bankable transaction that can benefit for private sector bids or private sector lending. Or in some cases, maybe advising on a specific transaction going to the bond market. I'll close with just an example of that. In Southeast Asia, we have a green, social, and sustainable and other themed GSS Plus bond initiative. It's really under the supervision of ASEAN, but we do it directly with public sector issuers. And that's where we engage with an issuer on a signature issuance, help them structure it, align them with taxonomies and other standards, and then help to engage the investor community so there's a fair amount of trust in what they're buying. And through that program, just to give an example, we've brought to market $3 billion of GSS Plus issuances, and those sponsors or those issuers have gone on to raise another 10 billion on the back of that. And that cumulative 13 billion is of a market that is cumulatively 50 billion. So 13 out of 50 really coming from this kind of advisory operations, which we think it could be transformative. It's not measured in lending. It's not ADB money going out the door to projects, but it is really trying to build demand, to build trust, visibility, good case studies that can then snowball as the market grows. So I think that the broad answer to your question, Alexander, is that both directly and indirectly, there's a lot institutions can do to, like ADB can do, to mobilize resources, both public and private, so that the private sector can engage in climate action.
Thank you, Scott. Very comprehensive. So the whole range, everything from financing, advisory, and if I may add, also technical advice. And of course, more than happy to engage with investors that might be here on the call and private sector representatives. I think with that, it's maybe all the time to actually turn over to the market participants and hear the views, and particularly from Jason, who agreed kindly to be on the call today. I see two questions, I think, Jason, that you might want to tackle, or I actually take them together. Both touch on the greenium and the risk return profile. So if you can talk about broadly maybe what this means in terms of the bankability of the projects and how this all squares from your private investment view.
Sure. Thanks very much. So yeah, first of all, I think that the concept of bankability, especially for climate finance and investments, is a little bit different from the concept of greenium. But let me just quickly break it down. So when you think about bankability of projects, it's not just a pure matter of how much money is this going to make, or is this project a good investment. I mean, there's a lot of different factors that go into that. That market participants and investors are going to have to consider, not just the the profitability, as I mentioned, but also the mitigation of risks, whether that's project risk or technical risk or political risk. Is there insurance available? If they is there permitting in place? How long is that going to take? These are the type, or even ESG factors, like what is the potential kind of social acceptability or maybe community pushback against a very large project. We've seen that, for example, in some kind of mega solar projects, especially here in Japan. So these are the types of the questions that investors are going to have to answer as they screen these types of investments. And that is really, I think, important for policymakers to understand that concept, that it's not simply a matter of just, if you throw enough subsidies at it, or if at a particular project type, that investors will just flock to your door. You really have to kind of think, down the line, what are all the different factors that affect the bankability of those projects? And, what are the bottlenecks that are maybe keeping private capital from being able to do that? I mean, for example, with clean energy projects, clean energy, solar, especially being very economically viable, very low cost, very bankable, typically type of project actually for private investors. But in some contexts where perhaps permitting is not available, or certain regulations in the power sector don't allow you to have clarity on, let's say, offtake, or whether or not you'll be able to repatriate profits, what will be the currency convertibility and hedgeability. These are the types of downstream issues that can be addressed separately by policymakers to really raise the bankability of climate investments generally. And I think you'll be able to find a lot more success in raising private capital, even in more challenging market situations. Now, regards to greenium, which is a concept that we have, especially in the bond market, where we can compare, for example, the pricing of conventional bonds versus green bonds. Green bonds being those bonds that have a set green financing framework that stipulates that the use of proceeds will be used for projects with a positive environmental impacts. Typically, green bonds, aligned to the ICMA principles. Now, what you can do is with this is that you can observe in the market pricing of these different instruments whether or not there is a premium being paid for the green instrument, for example. So if there's a premium, it's a greenium. If there's not, then well, there's no greenium, and you can check that. And what we have found is that this is largely, and what I think is very important for people broadly to understand, is that this is largely a matter of supply and demand. So if there's more demand for green financing instruments, then you will typically find a greenium. If not, and supply catches up with that, then you're not going to see so much of a greenium. And that's the general trend that we've seen. I think it's important that investors really think about, and the way that we look at it is to think not necessarily to pay up for an instrument just because it's green. Because remember, these bonds are pari passu typically to the issuer's credit. So whether you buy a green or a non-green bond from the same issuer, it's going to have the same economics. It's going to have the same kind of credit risk. So in theory, economically, value-wise, it's not actually rational to pay up for that. But if you can think that actually by issuing green bonds and funding those green projects, and thus getting, if the issuer is thus, accelerating its transition to a more kind of a net zero aligned state, or perhaps reducing those transition risks, that may in fact be well, worth it to investors generally to pay up for, and may make that credit profile more attractive by de-risking. So that's the kind of thing that we can think about in terms of greenium. Whether or not it always exists, or how to kind of raise that greenium, make it more attractive for investors, we can kind of talk in a separate question. But I think I've addressed enough right now.
Fascinating. Thank you so much, Jason. Quick, just one small clarification. So you mentioned this acronym ICMA, so the International Capital Market Association. I think important for our audience. If I may, just for the moment, stick to your expertise. There is a follow-up question, or I interpret it as such, by Javier, and she's wondering, or he wondering in particular about the maturity horizon. So often of both investments in adaptation and mitigation come with a longer horizon to generate returns. How are you juggling this?
Sure, that's a great question, and one that the market is really quite focused on, especially these past years. Mitigation and adaptation projects, these are basically the two flavors of kind of climate investments that we have. Mitigation, obviously, being things like solar energy, renewable energy, and EVs, things of that nature, that can help prevent climate change and reduce emissions. Whereas adaptation projects are more kind of dealing with the impacts of that, whether it's climate resilient infrastructure, or nature positive investments. So, for example, mangroves that provide natural services, as well as environmental benefits. Now, this comes back to that question of bankability, which I mentioned, which is really what the market is dealing with. We've seen that there has been a slowdown clearly in terms of climate policy and climate ambition recently. So that means that we are somewhat off track from our from global climate goals. So obviously, it seems to me, and I think a lot of people, that the attractiveness of those adaptation projects may actually be rising as the risks from climate change are also rising. So we need to do something about that as well. The reason that those are much harder to finance, and you see a very much smaller amount of investment going into those types of projects, is again that question of bankability. As I mentioned, it's very simple to create an investment case for a mid-scale solar or renewable energy project somewhere where it's a repeatable process. It's been done many times. It's the risks are very well known and controlled for. Whereas something like let's say a mangrove restoration or some sort of climate resilient infrastructure, those the benefits of that, the cash flows are much harder to realize. In fact, there may not even be any cash flows in many cases for these adaptation projects. That is then going to be very difficult for bankers and investors to put, return-minded investors anyway, to put capital behind. Thus, we say that these are not yet bankable projects. That's really where the blended finance concept comes in, and where MNDBs like Asia Development Bank are so key in really kind of supporting the market and addressing those factors. So whether it is providing first loss capital or other types of financing inducements or insurance or structuring the deal so that it can attract some private capital and begin to develop and scale in an economically viable way. That's really going to be quite important for us to realize the promise and the urgency actually of adaptation projects. Another factor I think quickly at the end is to say that we talk a lot about the concept of resilience these days, climate resilience especially, and so the question though, so I think it's quite well recognized in the market and any rational person that it makes more sense, let's say, to spend an extra 10% on construction costs of a bridge or some infrastructure that's not going to be washed out in the first torrential flood of the season, right? But the problem for the market is that how do you actually realize those gains, right? How do you actually, you've paid the higher cost. How do you actually monetize the resilience of it? And so that's, I think, a new question that we start to need to look at and think about how can we structure these deals so that you can actually monetize the resilience, for example, against climate impacts. That'll go a long way to making these adaptation projects more bankable and thus scaling up investment in those projects.
Excellent. Very good. You're bringing in this distinction here between addressing the mitigation and the adaptation side. I take from this answer and the first part of the previous one that clearly there is an important role still to play for the policymaker to create an enabling environment. And that, for me, is the perfect segue to circle back a bit to the role of the policymaker. I'd like to turn it back to Esmyra here. And also in addressing then two of the further questions we got here in the chat, there is one notion by Rosalind, which is about essentially how can we overcome the generally, for example, shallower capital markets in developing countries? What could be the role of the policymaker, both in the country, but also say from our point of view as an MDB, multilateral development bank. I think this also to some extent addresses Ashim's latest question from 1043 about the generally higher financing costs in the global south, quote unquote. Esmyra, please.
Yeah, thanks, Alexander. And I think Jason have actually touched on some of this replies that I'm going to give. But I think one critical answer to Rosalind's question is the enabling policies, right? For example, and I think there's another question related to this. Countries like Vietnam and the Philippines have actually successfully attracted private sector investment through some of their policy incentives, which included actually feed-in tariffs and some tax exemptions on clean technologies. So that's one aspect of it. But another aspect, and again, it has been touched on by Jason, is that about blended finance. So blended finance and actually including de-risking instruments such as the use of guarantees, concessional capital, and insurance improves the project viability. So if these are in place, then it can actually encourage more private sector participation. And I think Scott has also mentioned about public and private partnerships. Now, especially in the context of adaptation, financing for adaptation, which as again, it's harder to finance because there's a lack of revenue streams and it has some public good characteristics into it. So, in fact, we acknowledge that public finance is critical to actually help de-risk this kinds of project for private sector. So, public-private partnership is actually also critical. But if I can go back to blended finance, actually, what we're sometimes forgetting is that philanthropy can actually play a critical role. It doesn't figure in too much of our work in the MDBs, but there is a growing fund out there that are coming from philanthropies, including the Rockefeller Foundation, which has actually contributed much to a private sector operations in terms of related building resilience and sustainable development projects in our private sector operations. So those are some of the possible contexts, but at the same time, in terms of adaptation, since Jason has already touched on, there are quite a lot of opportunities, especially in agriculture and resilient infrastructure. Climate resilient, you know, drought and stress resilient tolerant crops is a possibility. Climate smart technologies and is another way for them to invest, because I think private sector themselves has to also look at adaptation investment, not just in the financing, but they themselves has to also adapt their operations to the risk of the impacts of climate change. And again, there's a growing initiative and programs globally that is actually trying to address that. But yeah, looking at the time, over to you, Alexander.
Very, very good, Esmyra. So I take from your answer also that we are not alone in this. Certainly, surely there's the public sector in the various member countries. There are the MDBs, but there are also the philanthropic organizations that are helping to fight this cause. Very good. I'd like to almost getting to the end of our discussion. I'd like to turn to a question by Riaz Reed. I like it a lot because it's helping us to shift a little bit the focus of the discussion and also highlight our role maybe as ADB and being the platform for regional cooperation and integration. So Riaz is wondering about the cross-border cooperation, particularly say on energy transmission efforts. And I think our colleague Scott would be well positioned to address that. Please, thank you.
Thank you, Alexander. Mindful of time, I'll just give a very quick answer to a very rich question. The opportunity to connect countries for the transmission of energy, particularly renewable energy, is a linchpin, I think, of energy transition in the region. And in Southeast Asia, it's been really fantastic to see the momentum building around this idea that has been building for some time, the ASEAN power grid. I guess what I would say, just by way of summary, is that this is really a crucible of all of the issues that we've been talking about on the call today. We've seen a transition from public sector investment to increasingly private sector activity to get projects going. We've seen scale ambitions that are really driven by a resilience and energy security agenda, but also a green agenda increasingly, because there is a mismatch of supply and demand of power, and a lot of that is driven by renewable energy sources in exporting countries. You see a range of different financial intermediation issues that can be solved through blended finance. And then finally, the project pipeline issue. How do you surmount risks that are first-of-kind risks for subsea cables and the connections of countries that maybe have not been connected before? I guess I would just point to a couple of things that are happening. One is that there has been a mobilization of the development and investor community around this agenda, and I'm pleased to say ADB is really at the center of that, working directly for ASEAN, but also for private sponsors and for countries that might be building or buying these assets. Secondly, that there is a real focus, I think, now on mobilizing climate capital for this. And the data and disclosure standards we've been talking about, I think, are really key to that. How do you ascribe green benefits to a project that may be a transition asset? And so we've been working with a number of funders to make sure that that's done so that blended finance can be supported with catalytic capital from donors and so forth. And then finally, thinking a little bit about project structures and mitigating the risks that Jason talked about. Really, project preparation is going to be absolutely essential. And here I'm pleased to say we're engaged with a number of sponsors. And if there are others who would like to work with us in ways we can scope a project in terms of how it's structured or fund preparation activity, this is certainly a core focus of ADB, given the outsized benefits for development and for climate action. Thanks.
Perfect. Excellent. Thank you so much, Scott. So with that, I'm afraid we're a bit up against time. My personal apologies also to everyone who's joining today, whose questions might not have been fully addressed at this point. I believe many of them we, though, have touched upon, such as, for example, Justin's question here on the difference between adaptation and mitigation. And of course, all of us, both panelists, presenters, and even myself, will be happy to answer any follow-up questions that you might want to shoot at us in writing. Now, in closing, or to wrap it up, I'd like to give all of you another opportunity to maybe leave us with some parting thoughts, to just reflecting on our discussion. If you could, one final statement up to, say, roughly a minute. I'd like to start with our dear presenter, Grace. Maybe your views on how the discussion has been capturing or reflecting the presentation.
Thanks, Alexander. Since I'm currently working on climate policies, so I do see that I wanted to say that actually a good mixture of effective climate policies will be very important to mobilize climate finance, which not only boost the investments by forming incentives, and then also actually gives a clear guidelines, and then strengthen the confidence in the market of the investments. Together with matching market development, I think government can really play an important role in channeling private climate capital. Thanks.
Excellent, thank you. Esmyra, you're next, please.
Yeah, thanks, Alexander. And I'd like to thank all the participants for their active engagement in this webinar. It's unfortunate we were unable to reply to a lot of the inquiries, some of the inquiries. I guess one thing is that private sector has been acknowledged a critical sector to actually scale up financing in this space. Globally, it is touched on the new collective quantified goal, as well as the Baku to Belém roadmap to 1.3 trillion. Now, I think as parting words, I think one is that we should move away or move beyond vague calls for mobilization, but actually try to translate some of this to actionable strategies with well-defined responsibilities, develop investment products that are familiar and replicable to attract institutional capital, and as we say, develop bankable projects. But I think one critical part being, in the climate finance reporting sphere is that we want to enhance data transparency and reporting standards as well. And I think this would actually to investor confidence and would actually scale up private sector financing as well. Yeah, thank you.
That's a fantastic call for action. We should almost put this in writing on the final slide. Scott, if I may ask for your parting words.
Sure. I think we've been reading in the news, and it came up a little bit today, that climate investment for private sector is sometimes under attack. I think the counterpoint to that is the enthusiasm and engagement we're seeing from countries, particularly in the region that I cover, Southeast Asia, where this is now core to their investment and national development strategies, but also increasingly interest to banks and investors. The first sustainability-linked bond that we brought to market in 2024 was oversubscribed by 2.7 times. You have the ASEAN Power Grid really bringing new private sponsors to market. We have a lot of impact investment funds. You have institutional investors and the like, all kind of coalescing around these points. So I think it's really about standardization and scale.
Great. Standardization and scale. That's what I will take away from this. Thank you. Jason, last but not least, what's your lessons learned from joining our panel with policymakers and economists?
Yeah, well, thanks again very much for the opportunity. It's really exciting and good to hear that there's so much interest in this topic. Even as as Scott mentioned, there are headwinds. I think it's a good opportunity for us to really sharpen our pencils and address the bottlenecks and the challenges, and emerge really even stronger, because we've seen in our own investments that investing in sustainability actually does really pay off. We've avoided so many downside risks, so many big headlines, issues in the market. We've really been able to sidestep that in a demonstrable way with our approach, and I think it's really something that a lot of investors, mainstream and climate focused as well, need to focus on. Quickly, I'd like to really highlight just one little thing from our joint research for this paper. Joyce and I worked on this, and we really in a very practical sense, tried to analyze what is the degree of implementation of these kind of climate policies across about 120 different factors, and really map that to real world outcomes in terms of for example, renewable energy installation rates, new energy investments, total renewable energy as a total of the total grid generation, and we really found very positive relationships in all of these across the various countries and jurisdictions that we looked at. So I think it really paints a good picture that if you do these types of projects, implement these types of policies comprehensively, that there is a through line to real world outcomes, and that's what we really need to focus on.
Perfect. Thank you, Jason. Very impressive findings. Just a reminder for everyone, what Jason just highlighted is available in a background paper, again, available on the website where the report and this chapter is being published. Maybe we can put it one more time into the chat for everyone to go and read it up. Well, with that, we are 2 minutes past the hour. So thank you so much, everyone, for joining this morning. Thank you to our presenters and panelists. It was a very rich discussion. I've learned a lot, and I hope so did you. And now, before we close here, I'd like to just invite you to join our next Asian Impact webinar. So the topic will stay on climate, and particularly climate mitigation, and discuss carbon pricing options and implications for Asia in 2 weeks from now, on the 7th of August. That's a Thursday, 2 to 3 p.m. Manila time. And again, please do join us on Zoom. Now, we also invite you to check out the Asian Impact webinar page and our Chief Economist's X account for any more updates. Well, that's it for today. Thank you for joining again, and see you soon.